So, in my early days of trading, I was like a lost, wandering soul, right? Around, trading forums, blogs, and websites trying to learn more about trading. So, naturally, right, one of the first few indicators that I came across is moving average. Okay? And moving average, I was taught that, to use this indicator properly, right, I should wait for the fast moving average to cross above the slow moving average. And that's when I buy, right? And when the fast moving average crosses below the slow moving average, that's when I sell. So it looks something like this, right? Let's say this is the slow moving average. And let's say this is the fast moving average. So when the fast crosses above the slow, you buy. Okay, so I tried this and, well, I lost money. Couldn't find success with it, right? And I decided to conclude that moving average is lagging, it's useless. Okay, so that was the conclusion that I had for a few years. But then as I matured as a trader, right, as I learned more and I look back, then I realized, hey, moving average is not as useless as it seems, right? I was too naive and, I came up with such a simple conclusion based on the failed moving average crossover strategy. So let me explain, right? Let's say, for example, you are, you've witnessed a car race, a Ferrari against a Toyota Vios. So when they go and race together, naturally we can agree, right, that the Ferrari is going to beat the Toyota Vios hands down, right? It has stronger horsepower, bigger engine, a bigger CC and stuff like that. But are you going to conclude that the Toyota Vios is a useless car? Well, no. It really depends on how you look at it, because a Toyota Vios, it can fetch like a family of 5 or 6 people. A Ferrari can't do that. A Toyota Vios is a more fuel economy. It helps you save more money on fuel in the long run. So you can see that Toyota Vios, even though it can't beat the Ferrari head on, right, it is not useless. There are other users to it, and this is the same as moving average. Right, this is the same concept I'm trying to bring across. It's just because the moving average crossover doesn't work, it doesn't mean that this indicator is useless. Right, because in today's video, I'm going to share with you, right, moving average trading secrets, right, that I've learned, right, over the last few years of trading. Number one, right, I'm going to share with you how you can actually identify, right, the strongest market to trade, right, to buy the strongest and short the weakest. Number two, I'll share with you how to better time your entries, right, with moving average, so you enter your trades when the market is just about to move in your favor. Third thing, I'm going to share with you how to actually, trade along the path of least resistance, so you can increase the probability of your winning trade. And finally, we'll talk about how you can use moving average to ride massive trends in the market. So there's a lot we're going to cover in today's video, so let's begin. But first, alright, hey, if you're watching this video, it's your first time, it's your 10th time, doesn't matter, hit the thumbs up button below and subscribe to my YouTube channel. This way, you'll always be up to date, right, whenever I publish a new video just like this one you're watching right now. So go ahead, take 1 second and do it, right? One, right, and let's begin. So first thing first, right, before we talk about the specific strategies on moving average, right, I want to share with you, and explain to you how moving average works, right? Because if you don't understand how an indicator works, right, whatever strategies, whatever techniques or tactics that you use in future, right, is going to be doing it in a blind manner without really understanding the core idea or concept behind this indicator. So let me spend just a few minutes explaining what moving average is and how the line goes up and down. So moving average is simply put, right, it's a indicator that takes the past prices and kind of summarize it. So let's say, historically, let's say we talk about 5-period moving average, and the price goes something like 1, 2, 3, 4, 5, right? Let's say these are the prices on your chart, right? $1, $2, $3, $4, $5. So what the 5-period moving average is going to do is going to take the total value of the prices and divide by 5, because it's a 5-period moving average. So the total value of this is let's say 1 plus 2 is 3, 6, 10, 15. So 15, right, divide by 5, because there are 5 values, right, because it's a 5-period moving average. The moving average that's going to appear on your chart is the value of 3. Okay, and now let's say, another number forms up. Let's say now this time around the number is 10, okay? So again, it's going to take the last 5 numbers, which is number 10, number 5, 4, 3, and 2. So you add up this section over here, so you get 19, 22, and 24. So 24, right, 24 divided by 5, okay, you're going to get a value of 4.8. Okay, so your moving average will appear a value of 4.8. So this is the core idea behind moving average. It simply takes, right, the past prices and divide it, right, according to whichever moving average parameter that you've chosen. So in this case, this is a 5-period moving average. If you take a 3-period moving average, it's just going to look at the last 3 numbers and then divide by 3 and etc. Okay, so that's how moving average, the values are being derived. So of course, right, there are different ways moving average are being calculated. We have exponential, simple moving average, weighted moving average. Just some slight nuances, right, behind the way they are being calculated, but the core concept is pretty much what I've just shared with you. Okay, now that you've understand, right, moving average, how it works, why the number moves up and down, let's look at the first secret about moving average that I want to share with you. The first thing that I want to talk about is using moving average, right, to find the strongest market to trade or the weakest market to short. So here's the thing, right, about markets is that usually if you notice, right, a market, the first market that breaks out first, okay, that tends to be the stronger markets, and you can expect the move to last longer. So this is a concept that we call relative strength, identifying who are actually the stronger ones and who are the weaker ones. So let's say, for example, right, right now this is the chart of dollar Sing. So how you can do it is just pull out a moving average. For example, this one we're going to use is the 50-period moving average. Okay, and you notice, right, that this market is actually in somewhat of a ascending triangle. Okay, notice the higher lows into this area of resistance, and notice that right now the price is somewhat below the 50-period moving average. So let's say you're deciding between dollar Sing and dollar against the Chinese yuan. You can't decide which market to long, right? Let me just pull out the dollar against the Chinese yuan. And you notice that dollar against the Chinese yuan is similar to the price action as dollar Sing, as you've seen earlier, another ascending triangle. But this time around, right, notice that the price is actually above the 50-period moving average. Whereas the dollar Sing one that you've seen earlier, okay, let me just see if I can find it here. Just add the symbol, alright, so we can just track easily. Right, the dollar Sing that you've seen earlier, the price is actually below it. Whereas the dollar against the Chinese yuan, the price is, this is bad. Okay, dollar against the Chinese yuan, the price is above it, right? So what this tells you is that if you are deciding between to buy dollar against the Chinese yuan or the dollar against the Sing, you want to be going with the dollar against the Chinese yuan because it's showing you sign of strength. It's stronger than the dollar Sing because the price currently is still above the 50 MA, whereas dollar Sing, the price is below it. So this is a sign of strength, and there's a good chance if the dollar yuan breaks out, right, the move will be stronger and you'll last longer compared to dollar Sing. Okay, so this is one way you can use relative strength to help you identify which are the stronger markets to trade, right, and to kind of, avoid the weaker ones. So another example to share with you, right, is let's see. Let's look for Aussie yen, right? Same concept, just want to, explain it more in depth. So Aussie yen, let's say for whatever reason, let's say you are bullish on this market. Maybe the price has, broke above this swing high, right? This was a small range. Price has break out of it. Right now it's consolidating, and you think that the market has room to move higher. Okay? So this is the Aussie against the Japanese yen. And now at the same time, you notice that there's another market with similar price action, right? It's the New Zealand yen. And you somewhat can't decide, which one to buy. Should you buy the New Zealand yen or the Aussie yen? So this time around, right, if you notice, both of this market, they're all above the 50-period moving average. So another technique that you can use, another variation of it, is to look at where the price is relative to the moving average. Both of them are above the 50 MA, but if you pay attention to the New Zealand yen, it has a much wider distance away from the 50 MA, showing you a sign of strength because the market is strong. That's why it is further away from the moving average, right? Notice there is quite a distance over here, whereas you compare with the Aussie yen, it's much closer towards the 50-period moving average. So this tells you that the New Zealand yen likely is a stronger candidate, and if you are bullish on that market, you want to be buying the New Zealand yen. Okay, so this is how you can actually use relative strength in your trading to identify the strong markets and even the weak markets. The concept is just the opposite. So moving on, right, I want to share with you a technique, right, on how to actually better time your entries. You don't want to be entering too late. So this is a very powerful technique, okay, to share with you. So if you look at palladium, let me just remove these lines first. Okay, so in this case we are using the 50 MA as well. So if you look back, right, palladium, historically, this market, it tends to respect the 50 period moving average, right? This is the area of value on the chart, right? It's quite obvious. It tested once, twice, three, false break over here, 4, 5, etc. So you look back, just eyeballing, right? You know that this market, right, it tends to mean revert towards the 50 period moving average. So from a logical perspective, if you look at this market right now, right, let's say, often market is bullish, right? Many traders will think, oh, market is breaking out, let's buy, right? It's bullish, let's buy. You want to pause and think for a moment. Why is that? That's because if you look at this price action of this market historically, it tends to mean revert back towards the 50 period moving average. Okay? So if you want to buy over here, there's a good chance that this market could mean revert back towards the moving average, and you would have to endure that drawdown, or you might even get stopped out of your trade if your stop loss is too tight. So from a risk to reward standpoint, right, a much better time to enter your trades is when the market is near the 50 period moving average. So in this case, it's a matter of being patient and let the price come to you. And in this case, right, it did come to you, right? And this is a much more favorable trade location to enter your trade, right? Entering from an area of value. Okay, so this is a very good example. Palladium on trying to better time your entries and not just blindly chase the market because there is a big breakout. So one more example about dollar against the Indian rupee. So I'm just using the 50 MA here, but again, it can be 30 or 40. It doesn't really matter. The concept is really what matters, okay? So dollar against the Indian rupee, similar story. Okay, you can notice that the market, again, pretty much, making highs over here. Again, at this point, you don't want to be buying at this price level, even though it did make higher, right? So at this point, again, you don't want to be chasing the market up at this highs. Okay, a much more favorable trade location is to wait for the market to retest closely towards the 50 period moving average. In this case, you can tell that we did miss the move, right? The market continued higher, right? And eventually now it break down. Okay, but the idea here is still that in the long run, right, you really want to be trading when the price is close to the moving average, as close as possible. If not, right, you would see that often market makes a huge move, right? A huge stretch away from the moving average, then it snap back, right? And you get stopped out of your trades. So just share with you another example, right? I think Brent crude oil is a good one. Okay, so right now, again, if you look at this, right, 4-hour time frame, notice that this market, again, tends to come somewhat close towards the 50 period moving average. So again, you don't want to be chasing the market over here or over here, right? The price is, so far away from the 50 period moving average. Instead, wait for a pullback, get a more favorable trade location, somewhere here. So don't just chase the market. Look at where it is, right, relative to its mean reversion area on the chart. If the 50 MA is a good mean reversion area, you want to pay attention to the 50 MA. Sometimes it might be the 30 or the 40. It doesn't really matter. The concept is what matters. So you want to identify the area of value on the chart and try to trade as close as possible to it. The beauty of it is that if you can trade as close as possible, let's say as close as possible towards the area of value, let's say somewhere here, right? You enter your trade somewhere here. Your stop loss can be tight, right? Just a distance above this moving average, a much tighter stop loss compared to chasing the market going short over here. Your stop loss now is so wide. Okay, so it is again, right, trading from an area of value, you have a more favorable risk to reward on your trade. Plus, right, you don't really have to endure the kind of drawdown when the pullback comes. So that's another thing that I want to share with you with moving average, right? Help you identify the area of value and to better time your entries. Moving on, right, the third thing that I want to share with you is how to use moving average to identify the path of least resistance, otherwise known as the trend. So very simple, right? Just again, let's have a look at example. Okay, so this is euro dollar, right? So when every time look at the trend, I like to use the 200 MA to kind of see, right, where the long-term trend is. So if you look at this 200 MA, right, this black line over here, notice that the price is below the 200 MA. So often, right, if you've seen my videos, I always say, right, if the price is below the 200 MA, right, look for short setups, meaning you want to look for opportunities to short the market. If the price is above the 200 MA, then look for opportunities to buy. Okay, so in this case, if you pay attention, right, the price right now is below the 200 MA. Okay, so opportunities to short in this market, possibly the market retesting back this swing high over here, right? That would be opportunity to short. Also, you have the confluence of the 200 period moving average. So again, right, this would help you trade along the path of least resistance, right? And it will actually, increase the probability of your trades, right? Because you're now trading with the trend. Okay, so the 200 MA is a very useful guideline to know, whether you should be long or short. So another example, let's say we look at a pound dollar. Okay, I'm just going to pick this out. Concept again is the same, right? If you look at this, right, the market right now, it's pretty much below the 200 MA. So what should you be doing, right? You want to be shorting the market. You want to be selling. So again, where do you sell? Again, possible area of values at this swing high over here. Market could retest up higher, right? Get a price rejection or something, and then market hits lower. Okay, so this is a very simple barometer, a guideline to know which is the direction that you should be trading. However, I also want to share with you that there are times, right, where it's not very obvious. Okay, so just want to I just really want to be honest, right, and kind of let you know that no indicator is it works perfectly. There's always pros and cons to it. Even the 50 MA that I shared earlier, right, if you wait for an area of value, the price might move further in your favor and you're not in the trade. That could happen as well. And same thing, right, for the 200 MA. There are times where, if you look at the price action of the market, right, let's say you look at the daily time frame. Okay, right now, okay, I forgot to mention, right, whenever I use the 200 MA, right, I like to plot it on the daily time frame, right? I'm not sure where the indicator disappeared to, right? So let me just get it out. Okay, I like to reference it on the daily time frame. Okay, let me just pull it as 200. Change this to black. Okay, so yeah, right now you can see that the price right now it's below the 200 MA on the daily time frame. So what I'll do is again, by right, since I said that if the price is below it, you want to short. However, if you think about this, right now, if you want to short, if the price comes above into this swing high, the market now is back above the 200 MA, so you should be long. So now you might face this issue of kind of like confusion, a conflict, right? You're trading from an area of value, but it's trading against the long-term moving average. So what now? So if you ask me, right, I would always give more weightage, right, to market price structure. That comes first, because moving average, after all, is a lagging indicator, as what I've just shared with you, right? The way they're being calculated, it lags the market. So whenever there is always this conflict between price action and the moving average, I go with market structure, I go with price action. So with that said, right, from a price action perspective, you can also see that, this is an area of support, okay, and this is the area of a resistance. So now, yes, right, the price is below the 200 MA on the daily time frame. By right, you should be short. But if the price were to come into this area of support, right, I'm not going to short just because the price is below the 200 MA, right? This is where, you have to use a bit of discretion and to know, what comes first, right? For me, price action always comes first. So in this case, if the price comes into this area of support, right, I want to be buying, even though the price is below the 200 MA. So as I've said, right, the 200 MA is just a guideline. Really, for those of you who are new to trading, you do not know how to analyze the market, you can pay attention to the 200 MA as a rough guideline. But bear in mind, right, you will face scenarios like this, as what I've just shared with you, right, where you have to make a choice. Are you going to pay attention to the moving average or the market structure? And for me, I always go with the market structure. Okay, so this is a very important thing to note, right? And briefly, let's just go back to euro dollar, because I think we're on the 4-hour time frame earlier, right? Euro dollar. Okay, you can see here, right? The concept is the same. This time around is more clear cut. Daily price is below the 200 MA on the daily time frame. So again, an area of value on the daily time frame is somewhere here, right? Somewhere towards this area of resistance, which is has the nice confluence of the resistance plus this 200 MA. All right, so this is where I get my bias, right? Because I trade a lot of the daily time frame and the 4-hour time frame. So I always pay attention to where the trend is on the daily time frame, and then from then on, right, I would base my trading decisions. But bear in mind, right, as I've shared earlier, there is a very high possibility where you will face a conflict between market structure and the moving average. And for me, always I go with market structure, because moving average, it tends to lag the market. So the final tip, right, that I have for you for moving average is this. It's how you can actually use it, right, to trail your stop loss. Very powerful. And it's very simple. Let me just remove these lines, all right? Let's say for whatever reason, you look back at this chart historically and the market, I think it did break out here. Okay, then it formed somewhat of a trend continuation or bull flag pattern. The market then broke out higher and, pretty much, made quite a huge move. So how could you have, ride the trend? So in this case, right, you can actually use moving average to help you trail your stop loss to ride the trend. So one way is you can use the 50 period moving average, this blue line here. Notice that the market, the price only breaks and close at this level over here. Okay, so this means, right, if you were to trail with the 50 MA, you would have ridden the move up higher and exit only somewhere about here. So that's a pretty huge move. Alternatively, right, some of you, might choose to be more longer term, right? You can even trail with a 200 MA. So let me just remove the 50. And you trail with a 200 MA, which is this black line over here. And you can see that you would have stayed in a trade longer and exit when the price breaks and close over here. Okay, so alternatively, some of you might choose to go with a shorter term moving average, like a 20 period moving average. Let me just change this to 20, all right? Just remove the black one first. Okay, so in this case, right, the 20 MA, you would have exited the trade earlier, right, with a smaller profit here. So at this point, right, some of you might be thinking, oh, Rainer, so, I guess I should go with the 50 or even the 200 MA because, I get to ride longer term trend. Well, the answer is yes and no. Okay, it really depends on your trading goals, because in this example, even though the 20 MA, you have a smaller profit, right? Okay, your drawdown is lesser because you give back lesser open profits. Whereas the 200 MA, right, the longer term moving average, you would actually, risk back giving even more profits. However, the upside to the longer term moving average is that you get to catch a longer term trend. You don't get shake out too easily. So there's really pros and cons to, whether you want to use a shorter term moving average or a longer term moving average. There is no best approach, right? It really depends on the type of trends that you want to capture. So as a rough guideline, if you want to capture short-term trend, right, 20 MA, it's a pretty much a good parameter to use. If you want to capture a medium-term trend, right, anywhere between 50 to 100 MA, it's pretty good to use. And if you want to ride long-term trend, right, 200 MA, it's a good one to use. As mentioned, right, no best approach, right? This one, the good thing about shorter-term moving average is that your drawdowns are shorter. However, you tend to get shake out of a trend earlier. Okay, meaning you get stopped out on the retracement. Longer term moving average, right, the beauty of it is that you stay in the trend longer, you don't get shaked out as easily, but you have to endure a deeper and longer drawdown. So this is the fact, okay? This is how you trail your stop loss, right? There is no magical parameter. Traders like to ask, hey, Rainer, which is the best number, as though there's something that works all the time. Nope, there isn't. So focus on the concept, something that I've been saying quite a number of times in this video, all right? That is really what's important in trading, the concept. So with that said, let's do a quick recap, right, to what we have learned today. First thing first, I talk about how to actually identify the strongest market to trade, right, by using a concept called relative strength. Okay, just give me a moment. Concept called relative strength. Second thing I talk about is how you can actually better time your entries. Right, I say that you can use the moving average as a guideline to help you identify an area of value. So if the price is very far away from the area of value, you don't want to be entering your trades at that point in time because the market is likely to pull back or even reverse. And entering when the market has, breakout so much higher, right, really increases your risk. So that's a very poor entry location. The third thing, right, how to identify the path of least resistance, right? What I recommend is that you can use the 200 MA to help you identify the long-term trend, right? Just overlay it on the daily time frame to know, whether you should be long or short. However, right, I also mentioned that there are times, right, where you will come into conflict with price action, market structure. For me personally, I always pay more attention. I give more weightage to price action and market structure. And finally, I spoke about how you can actually go about using moving average to ride massive trends. There's no best moving average, right? It really depends on the type of trends that you want to capture, whether it's short-term, medium-term, or long-term trends. Okay? So with that said, right, I hope you got a ton of value out of this video, right? Do me a favor, hit the thumbs up button and subscribe to my YouTube channel. And if you want to learn more about what I do, you can go down to my website over here, okay, tradingwithrainer.com. Over here, just scroll down a little bit, right? And there are a couple of trading guides here for you. If you want to learn more about price action trading, click this orange button here and I'll share with you more information, more knowledge on how to actually become a better price action trader, how to better time your entries and exits. We'll talk about market structure, support resistance, and much more. However, if you want to go and learn more or discover more about riding trends, maybe this is something that you are really, resonate with, right? You don't ride long-term trends, profit in bull and bear markets, then the ultimate trend following guide is for you. Just click this orange button and I'll send it to your email address. Both of these guides are completely free. So just go down to my website, tradingwithrainer.com, right, and download it and get your hands on it and study the materials. So with that said, I have come towards the end of this video. Any feedback or comment, just let me know below. Subscribe to my YouTube channel, hit the thumbs up button, and with that said, I'll talk to you soon.